So we are still under end of year adjustment. So after accrued expenses, now let us see how they treat prepaid. This one, the one we have paid in advance, the one you pay more money but have not used it. So here number two, our number two, we have prepaid. It's called prepaid or paid in advance. When you talk about prepaid or paid in advance, what comes into your minds? Of course, when you talk about paid in advance, these are these are expenses which have already paid for, but services are not yet used. When you talk about prepaid or paid in advance expenses, of course, you say these are expenses you have used. For example, no, you have already paid. For example, you can pay rent, and in paying rent, maybe you are paid for 6 trading periods. That means each year, when you are preparing financial statements, you get the total rent paid. Then you subtract for the period you have not yet used it. If you have used for 1 month, you subtract the other remaining 5 rent paid. When you are on second year, that means you remove the remaining period. So those are prepaid or paid in advance. For them, they are already paid but not yet used. In short, you wait for its trading period to use for them. That's why you always subtract them. And those things there, we record them under current assets because we still account them as our money, even though you have already paid for it. So those are prepaid or paid in advance expenses. Where I will say these expenses, they have already paid, you have already paid them, but you have not yet consumed or used the service. And we are going to see on how they are treated in financial statements. So in the financial statements, when you talk about prepaid expenses, in the financial statements, we will start with income statement. Under income statement, I've said they reduce the value of expenses. Then the financial position or balance sheet. They are recorded under current assets. Under income statement, it gives a value of expense, because I'll say this one you can be like you have already paid for more than one trading period. But remember, right now you are preparing financial statements for one trading period. That means you remove things for next trading period. That's and then under financial position, they are recorded under current assets, because you know, yes, they are no longer in your hands, but they are under current assets. You still count them as your money in business, even though you have not yet used them. That's why we are recording them under current assets. You still have that hope that you have your balance of money, the one we paid for rent. That's why they are recorded under current assets. Now let us look at some example how they are treated in the financial statements. Practically, let us see some example. So here in our trial balance, uh, in our trial balance, they can say rent. Trial balance, because these things they always bring them in the trial balance. It can be in trial balance, it can be like in word problem, like in word format, so any, as long as, but most of the time they bring them in trial balance. So you come into your trial balance and look for rent. But for example, here they'll say our rent is 1,000. The rent of the year, maybe each year you pay 1,000, 1,000, 1,000. But here they have said at the end of the period, where we have said it is most of the time it is always in additional information. They have said prepaid rent. They have said prepaid rent it is 40,000. That means out of rent of 1,000 in trial balance, because for trial balance they also show what they have spent or what they paid for. It is 100,000, and they have showed us in additional information at the end of the year that prepaid rent is 40,000. That means in the rent they paid, the one in addition in trial balance, there's that prepaid rent, the one they paid, but not yet used. So we're going to see how they treat it. So we're going to say solution, and we're going to start with our income statement. And of course, when you come under income statement, we shall come under expenses. Because rent paid is expense, it is under expenses. So under expenses, we shall say under expenses we shall say rent. Shall say our rent is 1,000, 100,000. You this time I'll say it prepaid. It's the value of rent, the one you paid, because for it you have already paid for it but not yet used. So after that trading period, you will be using it in another trading period. That's why we list it, because here we want to know which value are we going to pay in this trading period, the exact value. So we are going to list our rent, our prepaid, which is 40,000. Eh, so we have got our rent, trial balance, we have less prepaid rent to get. Eh, we shall get our rent paid. Our rent paid for that period, which is the one we record in income statement, which is 60,000. So that's how they treat prepaid or outstanding expenses income statement. Where we have said you get rent one they paid on the one addition trial balance, you just prepaid. So after income statement, now let us see how it is treated in financial. How it is treated in financial statement. In financial position. Of course, under financial position, you come under, well said, you come under assets. Then we have under current assets. We assume you have calculated for non-current assets. Then you come under current assets, and remember under current assets we have cash, we have bank, we have stock or inventory, we have bank. So we shall come under current assets and we will say our prepaid rent, and our prepaid rent is for 40,000. Then you add on other things. If you have liabilities, if you have what, then you balance. So that's how they treat prepaid outstanding rent, no expenses. For them, under financial position, you less. Under income statement, you subtract them or you less. Then prepaid rent under financial position is treated as current assets. Now, that is our prepaid outstanding, that is accrued and prepaid expenses. Now let us look at how do you treat income. When you find that you have accrued, remember I said we have accrued, we have owing, we have outstanding, incomes. We have seen under incomes, we have seen expenses. Now we want to see how do you treat incomes. But when you talk about incomes, yes, in income statements they remain the same, but when it comes to financial position, that's where it changes. So in short, like here, when say these are incomes, these are incomes earned but they are not yet these are incomes earned for, but they are not yet received. Maybe you have worked for someone, maybe you have your rentals, and anytime you are expecting to receive those income, but they are not yet received. So those we call them accrued or owing or outstanding income. You are still waiting for them, yet its financial period has ended. That means you bring that accrued income and add it on income of the year, or the one we have in trial balance. So here, under our income statement, our income statement, will increase the value of income. Then under financial position, it is recorded in current assets. Of course, we said under current assets, we record those things that you expect to receive money anytime. And of course, when we see accrued income, we have said those are incomes that you have worked or earned for, but they are not yet received there. So anytime you are expecting to receive money, that's what is coded under current assets. Now let us see how it is treated in the financial statements, like practically. So here we are going to say we have our trial balance. Under our trial balance, we have our commission. And our trial balance is showing us commission received. It is some example. We are looking at some example. I have said we have our commission received. Our commission received 20,000. Then in additional information, they have told us that they have accrued. We have accrued commission. And remember, under income, we have anything that is received. Maybe it can be rent received, it can be commission received, it can be salary received. As long as it is received, that is an income. So here we have accrued commission. We have our accrued commission of 5,000. So let us see how it is treated. We are starting with the income statement. So under income statement, we shall have, of course, you first get gross profit or gross loss. Gross profit or loss. Then, of course, after calculating net sales, cost of sales, like that. So under here we are going to say add incomes. But our under income has some transactions. So here we are going to say we have commission received, the value in trial balance, because I'll say they always bring it in trial balance, which is 20,000. you add accrued commission, which is 5,000. That means our total commission received shall have 25,000. So our under incomes you add 25,000. That's how it is treated under income statement. Under income statement, increase the value of income. Then let us how it is treated in financial position. Financial position. Under financial position, of course, I'll say it is under current assets. So we shall say assets, non-current assets. So we shall come and say under current assets. That's where we record our accrued commission. Because I said you have worked for it, but you have not yet received. So anytime you receive it, so you will come here and record 5,000. So that's how they treat accrued expenses. No, that's how they treat accrued income. Then now after accrued income, let us see how you treat prepaid income. If they give you prepaid or outstanding income, how do you treat it? Let us look at it, and we see how they treat such income. So when you talk about prepaid or accrued incomes, and say these are income. These are incomes earned for but they are not yet these are income earned but they are not yet consumed. Income earned for but they are not yet worked for. This for them, you receive these incomes, but at the end of the period you have not yet worked for them. You have already received those incomes, but you have not done what you are supposed to do. So now we are going to see under income statement. Under income statement, they reduce the value of income. Then under financial position, Under financial position, they are recorded. They are recorded under current liabilities. They are recorded under current liabilities. Of course, the reason why we record under current liabilities, you have received the money, but you have not yet done the work. That means it's your obligation to go and work. It's your obligation to go and work for those received income. Now, let us some of illustration. Say, for example, if this one we are going to see practically how they are treated in the financial statements. So when you check here, maybe we have our when you check here we have an example where they have said rent income received during the year ended 31st December 2022 worth shillings 500,000, of which shillings 100 of which shillings 100,000 relates to the year ending 31st December 2023. When you check our question here, they have given us rent income received at the end of 31st December 2022, but they have told us out of that there is some income of the other year, the next year, which is 100,000. So now we are going to see how it is treated in our income statement. We have said under income statement, rent income received during the year ended 31st worth 5, of which shillings, let's say year ending. So this time when you see they have given you the total income, so no more adding up because it's already included. This 500,000 of 500,000, it has already included 100,000. So this time under our income, under income statement, we shall come and say under income, shall come and say record rent income yeah, we are coming and say rent income received, which is 5,000. And this, because they have told us that 500,000 contains 100,000. We are going to this. We are going to this prepaid 100,000 prepaid rent income, which is 100. Because they have told us out of 500 there is 1,000 for the another trading, for another trading period. So we are going to come here and say when you get 500 and you less, we are going to get total rent income. Because when you get 500 you less 1,000, you remain with 400,000. So this is our rent income without the rent for next trading period. Yeah. So that's how it is treated. That's how it is treated in income statement. In short, sometimes they can bring this rent of 5,000, 500,000 into a balance. Then they bring this 100 additional information. So whichever way, you always check the. Sometimes we always check the dates. Then now let us see how it is treated in financial statements. When you talk about financial statements, when you talk about not financial statements, but financial positions, yeah, under financial position, of course, you see, this income, you have received it, but you have not worked for it. That means it's your obligation to go and work for it. Anytime. So we are going to say your fastest current assets, your fastest assets, non-current assets, current assets, owner's equity. Then you come under current, assets. Under current assets, we have, that's where we will come and see, let us add our prepaid income rent. Prepaid rent income. Prepaid rent income, which is 100,000. So that is a thing for today. Well, see now you calculate how you deal with prepaid income, how you deal with accrued income. Also, I'll see now you work with prepaid expenses or paid in advance. Well, we'll see how you deal with we'll see now you deal with well see now you deal with prepaid. So that's how you treat some of end of year adjustments. So here we are going to make summary of this year end of year adjustment. So here we are going to have income statements, income statements. Then here we are going to have financial. Here we have our financial position. Yeah, this is a summary. It is a summary. It is a summary of sum of end of year adjustments. So summary of end of year adjustments. So let us well said one we have prepaid. Let's start with accrued expenses. The accrued expenses well said. Here they increase under income. They increase the value of asset. They increase the value of yeah they increase the value of expenses. Then under financial position they are recorded under current liabilities. The current liabilities. Then let us see our prepaid expenses. Prepaid expenses and to increase the value of expense under income. Then under financial position it is recorded under current assets. Now let us go to accrued, the owing or outstanding income. In financial position, they increase the value of income. Then in financial position, they are recorded under current assets, because those ones were said you have already received them but you have not worked for them. Yeah, no, you have worked for them but you have not received them. Then the last one we have prepaid. Paid income. Well, we have said you have already received income but you have not paid, or you have not worked for it, so it will decrease or reduce the value of income. Then under financial position, it will increase. No, yeah. The financial position, we shall record it under current liabilities. So that is for today. Thank you for watching and thank you for listening. Next time we shall finish our end of year adjustments by seeing how they treat bad debts, provision for doubtful debts, and how they treat the usual depreciation and the end of year adjustments. Thank you.